in a moment here. I see he's still walking, but Andrew Warwick, who does operational due diligence at Typhon, is going to be our discussion leader. He is not wasting any time here, just in time at the workstation, ready to go. But he's going to introduce our distinguished panelists here and get things started as soon as he unmutes himself.
I really appreciate it. Sorry for the background. I thought I was going to have one of those wonderful white Typhon backgrounds. So yeah, I mean, we've done this panel in the past when it was a lot easier. I think this is going to be far more interesting a discussion than normal. With come to introductions, I like to sort of have everyone sort of give their own introduction. I myself have been a commodity trader and fund manager for many years, and have gone through quite a lot of due diligence, and I'm very used to face-to-face interaction. But I really haven't done that much of it by Zoom and over the phone until just recently. But today's going to be a good conversation of how things have changed. I'm going to ask each one of you guys to sort of give your own sort of overview and background, and then we'll dig in. So maybe Peter, we could start with you.
Sure. Can you hear me okay?
Yep.
Great. Thanks for having me on. Peter Bremberg, I'm the COO at Booth Bay Fund Management. We're a multi-manager, multi-strategy fund. We have approximately 100 different allocations through managed accounts to third-party managers, and we invest globally and strategy-wise, pretty wide set of anything that's liquid, level 1, level 2 assets.
Great. Gustav?
Yeah, it'll be a pleasure to be here. Thank you. Gustav Rydbeck. I'm a CEO at Balyasny Asset Management. I also sit on the investment committee for the firm. Balyasny is a little over $8 billion multi-strat fund. As part of my role, I help manage the front office long-short equity umbrella, which is kind of the core product for the firm. And so I'm happy to kind of go into detail on how we think about investment manager evaluation and diligence and whatnot as we get into the discussion.
Great.
All right. My turn, I guess?
Yes, it is.
All right. My name is Alexander Mende. I'm a senior investment analyst at RPM Risk and Portfolio Management based in Stockholm, Sweden. We consider ourselves CTA specialist allocators, so we only invest in liquid futures-based strategies, but not only trend following, but all other kind of strategies in that area. We've been around since '93, and I'm responsible basically for monitoring and manager selection for the whole due diligence process here at RPM, but also once the portfolio is put together for the allocation between sub-strategies and managers.
That's great. So thank you all for that. So first of all, the obvious. No one's traveling, no one's doing in-person due diligence meetings. I think we all know that. It's a lot more Zooms, a lot more phone calls. Maybe we could start off by talking about how it's going. Have there been technical issues? Have you been able to sufficiently get over the lack of face-to-face interaction, lack of physically seeing on site? Just give me a general state of how it's been, Peter.
Sure. So we obviously prefer to be able to go to a manager's office, see the whole team there, see their operation in person when it's possible. But the transition has been relatively smooth in terms of completing diligence on managers. Again, we're not, I would say, on the operational side, taking some of the same risks as if we were investing as an LP investor in folks' funds. So my answer might be a little bit different if that was our core business. But given we are able to control for a lot of the what I would call operational risks, not all, on our side by having daily transparency, that has definitely, I think, helped the transition from one degree. But in terms of investment due diligence and getting to know a manager, it's been a lot more Zoom than obviously before. But I think overall, to summarize it, the transition's been pretty smooth. We continue to onboard new managers, make new allocations. We've probably done 10 new investments since April. And yeah, so it's been an adjustment, but I think just like probably everyone else on this call, we've found a way.
Gotcha. What about you, Alexander? How's it been?
Well, we're based in Stockholm, Sweden, so we have a slightly different situation here. There were no lockdowns or no mandatory home office. Nevertheless, we have taken voluntary measures. So there have been a lot of working from home. There have been no on-site visits or visits here at our office. So, and we learned to use MS Teams and Zoom and everything like that pretty quickly, and we're doing it actually internally as well on a daily basis. So that has helped a lot. But I guess the thing that we as a company for our diligence miss most is the disappearance of those manager conferences, where you're not, the one-on-one meetings you can do in a like via Zoom, but hanging around after those meetings or at the dinner or at the cocktail reception or anything like that, that's something that where you get the not so official information that's missing, I would say.
Now, is that information about the manager, about the industry, about other managers?
Can be anything, can be gossip, of course, but can also be managers information about people who leaving manager A, starting at manager B, or starting their own shop soon, or stuff that you before you read it somewhere, I guess, basically.
Excellent. So Gustav, how's it going?
I would say for us, it's been pretty seamless. As a backdrop, we have a global footprint to begin with. And so, given that we're a US-based firm, we've had to diligence managers across Asia and Europe for a long time. And while you can, of course, have them normally come into the office and do meetings with more folks, it's the adjustment to do more over Zoom, and in particular over video Zoom, very quickly became clear that that's the way to go. So you actually get some connectivity, was relatively mild. But the other things that we've done to sort of adjust, other than more recently, we actually resumed sort of socially distant gatherings with potential candidates now where they're comfortable and they are aligned with one of our members of the senior management team. But we do a lot more focus on channel checks. Even in areas we rely on things like objective tests, personality tests, things like that to sort of vet out things that might be harder to capture over a Zoom call, which is essentially a pretty forced environment, if you will, or at least a very controlled environment, that if you go out to dinner with somebody or have a drink with somebody, people let their guard on a little bit, you learn a little bit more about them, and those types of advantages you don't have now. And so we're trying to come up with other ways to try to distill some of that information. But so far it's gone very well. There hasn't been any slowdown in terms of the candidate pool or our hiring amongst that candidate pool.
It sounds like things are getting a little bit back to normal if you're having face-to-face. When do you foresee things being back towards normal?
I think from an internal perspective, we're not planning on requiring anybody back in the office this year. So it's we have seen an uptick in terms of folks wanting to come back in on a voluntary basis, and we do allow that with appropriate disclaimers and whatnot. But where we've been doing it on the candidate side, it's really where there's just been kind of mutual interest and comfort level on that. And it'll generally be very small gathering, typically outside, things like that. And so, kind of making the best of an odd situation. But I think for things to really normalize, I'm guessing that won't be until Q1 or Q2 of next year, but it'll be gradual up to that point. I mean, even looking at places like Asia, or, we've had a lot of folks back in the office there over the last few months. And so I think we're seeing normalization in areas where the case count has been considerably lower. And so I expect we'll follow a similar trajectory in the US and Europe as things progress.
So it seems like, Peter, you've mentioned that you've made a number of allocations. Alexander, being in Europe, you probably see people a little less often. The question I have for each of you is, when do you feel comfortable making a hire, an allocation, or really taking an allocation from someone you've never met face-to-face ever? And if not, does that mean that you're more focusing on people that you have previously met and have relationships with, and maybe taking a second look at? Maybe Peter, you could take that.
Sure. We don't have a rule against, allocating to somebody we haven't met face to face. So the short answer is, yeah, we would. And in some cases we have allocated the, capital, open an account with somebody before meeting them in person. So that's not a hard rule for us. And yeah, so I mean, in taking capital, we are also raising assets ourselves, and there have been a couple of lengthy ODD processes over the last few months that have concluded, and but we never actually met the team in person. I would say maybe there had been like one previous in-person interaction, maybe between the allocator and our team in the past. But yeah, I think everyone on both sides of our business are pretty comfortable with not having to shake someone's hand necessarily.
Have you used any third-party consultants or any other services more local to where the manager is?
We have not. I mean, that's something that we may use from time to time, but for kind of the remote work environment, it hasn't been something we've needed to do.
Alexander, have you allocated to anyone you hadn't met before?
First of all, we only invest through our own separate managed accounts. We have an onshore and offshore platform, so the operational risk is limited on that side. That being said, we also have quite a continuous due diligence process, starting with screening and monitoring managers. And this year, we opened 2 managers. We have 3 more to open in the pipeline. We have 1 on the waiting list, and we have 3 to be approved for investment. All of those managers have not done an on-site visit due to Corona at their offices, but at some point we have met them in person before. So it's not really an acute pressing issue at this point if we can meet a manager in person, because we have such a large backlog that will last at least until the middle of next year, I would say. But we have done on like virtual Zoom or MS Teams based on-site visits, walking through the office with the cell phone and sharing screens and stuff.
So you say you have a pipeline that extends for 6 to 9 months. Beyond that, if the lockdown, at least in sort of Western Europe and in the US continues, how do you foresee your pipeline of new managers evolving?
Well, we are focusing on smaller managers, and those smaller managers typically don't sit in Paris, London, or New York. So they sit in the Rockies or even South Africa or East Asia. So I don't expect us to go there physically before the end of 2021. So we have discussed using consultants, and so far our experience with those virtual on-site visits has been okay to positive, I would say.
Gotcha. And Gustav, how do you see your pipeline of new managers evolving as this continues?
We've actually seen it increase pretty dramatically. I mean, I think in the near term, it was a little bit of function of kind of varying performance across the industry, as well as I think varying levels of how well different funds coped with it. You know, from a job satisfaction perspective, that we saw a lot of inbound calls from different managers, and so that was one thing that actually increased the pool for us. The second thing too was that with now we're 6 months into this, it's been at least for us a very seamless transition to working from home or at a lot of remote locations. So we've also opened up our kind of our willingness to look beyond sort of the core financial centers and the places we had sort of our core offices. So for the opportunity set, I think has never been better as far as we're concerned. So it's all about how you gain the same level of conviction that you used to.
Peter, how has your pipeline changed?
Similar. It's pretty. I don't think working remotely is as much the cause of it, but just COVID being the cause of why our pipeline seems very active. Similar to what I think Balyasny is experiencing. There's so much volatility at other firms because of the market in this year that it's creating great pipeline for us in terms of talent and again the market itself being I think a overall, I'm making a very general statement here about where the VIX is where it is. That tends to, at least for strategies we care about, create a better environment. So, the fact that people are leaving or setting up new firms, and the strategies we typically like having a better outlook, those things I think are playing into just as much as anything of why our pipeline's pretty full right now. And we, just as James has done an awesome job, adapting to the environment and doing these conferences over Zoom. So have other, cap intro teams and whatnot. So we've sometimes you maybe wouldn't have made a trip to a conference, but if it was being hosted somewhere else. But now that those things are available online, and a lot of people have adapted, I would say the inflow, the pipeline of talent and new strategies, I mean, it's definitely as busy as we've ever been.
That's great. Next I kind of want to talk a little bit more about the future. And maybe Gustav, I come back to you. Do you think things have changed permanently? Do you think there's a change of business flow as a result of this, which will never be back to normal?
Yeah, I do. I mean, never is a very strong word, but I think certainly for a multi-year horizon, I think there will be a permanent shift. I suspect, the way we're thinking about it, at least, is there will probably be a move towards, a more distributed geographic footprint. From my perspective, the benefits that you get from collaboration, having regular interaction and dialogue are very important, not just culturally, but also from a productivity perspective. But given that there are, at this point, there's at least a little bit of proof that you can be more distributed, I would expect kind of smaller offices that might be more aligned with where folks want to reside. I suspect we'll also move something that will vary by team, right? Certain teams, it becomes very important that you're in one location from a support perspective. It's hard to have IT support that's not on site, right? But there's other areas where there is very little reason to keep people on site. So I think there'll be a lot more flexibility and customization based on the role, which and the key thing to monitor with respect to that, because there's is not only productivity, but also I think down the line retention and cultural cohesion and things like that, which I think is at this point for me the biggest unknown after 6 months of sort of this work from home environment. And who knows, as we get into the winter as well, the being cooped up in one's house or apartment in Chicago or New York might feel a lot less exciting, than right after the end of summer. So, well, I'm sure we'll see some evolution, but I do think it's a permanent shift away from just everybody going into the office every day.
Alex?
Yeah, as I said, we didn't have any mandatory measures here taken. Voluntarily, we started working in shifts. Actually, the operations team has split up to do 2 shifts during the day. As soon as anything, as we decided ourselves not to use public transport or anything like that. So, and cars are very difficult to get in the inner city in Stockholm. So, if it's raining, people decide to start working from home instead of walking or taking the bike to work. So that's gonna stick around, and for at least over the winter, I would say there will be a lot of more working from home over the winter. Regarding managers, well, we have a global approach since day one. Managers, as I said, the smaller managers are in a lot of exotic places, which was always fun with my job, traveling to those places. But that, I guess MS Teams and Zoom work quite well, actually. So there will be significantly less traveling for me, I would guess. That's because it's also a cost issue now that flights have become more expensive after COVID, and I think that's going to stick around. You don't book the cheapest ticket anymore. You have to do full flex and everything because you never know what's going to happen. So that's going to increase traveling costs quite significantly.
You mentioned earlier about the conferences. Do you think that in general allocators will focus a little more on the numbers and a little bit less on, the 5-minute elevator pitch or the meeting someone at a cocktail party?
Well, as I don't think there will be any physical conferences anytime soon, I guess that's the only choice they have, right? That we do, or that we have. So, yeah, but we have always been number crunchers in that way. So for us, not much has changed. It's just this little extra is missing.
Perhaps that's better for the introverted managers of the world.
Yeah.
Sorry, James. So Peter, do you think things are ever going to go back to normal?
I don't know. I'm overthinking the word normal. I can't see, people taking less advantage of technology, right? I mean, a lot of people have integrated that into their workflow and meetings. So I think that will definitely be something that stays with us. I think we are going to value meeting people in person though, and having them to our office and going to visit theirs and in person, I think will be, of course, I think important, but I just think that, the kind of forcing technology adoption on everyone will just make, I think, investment processes and clearly the work remote kind of situation for having your teams either temporarily or more permanently dispersed. I think those things are things we'll continue to use. You know, the industry's smart, and as people have adapted or adopted new technology and norms of doing Zoom calls, right? Some people never would have suggested to do a video call before, but I think those things are a little bit more the norm now. So I think those things will stay with us, but we're not. I wouldn't expect once, and I'm being maybe just optimistic about the health situation, but once things subside, I think people will want to travel. People will want to see other people in person to as much as possible.
And can I add something here?
Of course.
I mean, the on-site visit or seeing as an allocator, seeing a manager's office and how they've decorated or how representative it is actually a soft quality that plays a role in manager selection, right? If you're a small manager, a startup, and you have a golden desk or something, that's a bad sign, right? So that's something I want to see when I do my on-site visit. And therefore, I think on-site visits will come back once the situation improves.
So, maybe turning a little bit more to the specific purpose of due diligence, the purpose is to sort of validate all of the assumptions, the software, the service providers. Have there been any occasions in the last 6 to 9 months where you found something that, a manager you may have otherwise invested in, but you found some sort of error on the due diligence side, which gave you pause?
No, not in my case. Everything's, as most of the others say, it's pretty business as usual, and things are continuing. No, nothing exciting.
Maybe
to report. Sorry.
To expand on that, given the change in third-party service provider and sort of the higher quality, and it seems like the majority of service providers are higher quality nowadays. Peter, have you found any problems in the last 6 months?
I think in terms of service providers, other than an anecdote of, a prime broker or a service provider, notifying you that there's been improper information sharing that got through their systems. That's the only thing I can think of off the top of my head. But that's where we've probably focused the most is, and to be clear, that incident actually didn't really matter, but it speaks to something that's more that we have focused on, which is, with our team remote and our primes remote, things like wire transfers and susceptibility to theft. I mean, people will call it cybersecurity, other things, but just susceptibility of people getting tricked has been, we've been, our antennas have been up and, talking to our primes and making things more deliberate, maybe over email and a call. So on the operations side, we've just made sure our communication with our service providers is a little bit maybe more hands-on than before, just knowing that they themselves are not in their normal operating procedure kind of setup, and it's also led to delays in certain ways, right? Some, especially early on, back in March and April, when banks were all, adapting a lot more slowly, I would say, than the buy side, needing to kind of understand how quickly they'll be able to move if we need them to move and do something quickly. And so from both, I would say, the trading and especially the operations kind of treasury function, that's something we've had to pay a lot of attention to.
I mean, Gustav, what changes have you guys implemented? What have you found during this last 6 months of sort of new diligence?
Yeah, for us, I'll address the question a little bit more from what we're doing, being on the other side of the diligence process. Because with respect to the managers that we bring on board, they're all brought in-house, so we're not dependent on sort of the systems that they used at their prior place of employment. But so the things that we've done preemptively to further kind of improve the areas that I think are more susceptible in work from home environments, certainly training and focus around cybersecurity, or I should say increased focus on that, in additional compliance oversight and in compliance training, as you have folks that are distributed, not in the office, and monitor things like how often people check in with the compliance and whatnot, to make sure there's an active dialogue and to make sure that new managers coming in really appreciate and understand the importance of that. So those are things that we've tried to do preemptively. With respect to kind of focus from allocators that speak with us, we haven't really had any issues or concerns flagged. We are doing a lot more online demos, as Alexander mentioned, also sort of screen sharing, walking through risk systems, walking through live examples. That's actually things that we do not only with prospective allocators looking at us to give them a feel for the tools and the infrastructure and what they would normally get in an on-site visit, but we also actually do it with the managers that we look at to see how well they would fit into our systems. What would their portfolio look like within our lens, so we can evaluate sort of their fit from a risk perspective, et cetera.
Well, I see James popping up. Does that mean it's time for Q&A?
Yes, sir. So we've got one question from the audience, and let me just remind the audience that you could always ask any of our panel's questions by clicking the Q&A button at the bottom of your screen and hitting raise hand. But we've got one here from James Goldcamp at one of our sponsors, HedgeFacts. So James wants to know, as a self-interested provider of software, thanks for that disclosure, to managers for operations, are there common problems you see that need solving? So investors, do you guys see issues with managers that you think that there's software solutions that could help you on the diligence end?
Here at RPM, we have built all the systems in-house, and there have not been any problems. And as I said before, we only invest through managed accounts, so the manager has adapts in our system. So COVID has not changed anything in that respect at RPM.
Peter?
I think, yeah, really the only, I'm trying to give a good answer. On the technology side, the thing that's been I'd said the most important, I would say, is just more communication technology. So as people have mentioned Microsoft Teams, we use Slack, things along those lines. So those were, using technology to manage like shared workflow, things like that, which, we may have used in some degree before, becoming a lot more important. But in terms of, actual execution, EMS, OMS, PMS, those systems, I don't think working in this environment that really changes much. You had those systems before, they continue to generally work. Most people were working on, cloud-based in that manner before, so it made that transition pretty smooth, I think. But just in terms of actually doing diligence and document requests, information sharing, things like that. And again, we see it on both sides, from getting information from managers as well as sharing with institutions doing diligence on us. And yeah, and unfortunately, it can be pretty inefficient, and different folks can have their own, data sharing or document sharing repositories. But I think everyone would wish there is a central clearinghouse for that, where you can just permission data and information sharing to certain investors, and vice versa. As an investor, we can gather that. But and I know there's a lot of solutions or different products out there that kind of market to be that provider, but it is pretty fragmented,
I could maybe jump in with a sort of a follow-up question. Made me think about, during the actual crisis in March and April, what additional measures did you take from a diligence point of view when the markets were really moving? Was it more frequent risk calls? Was it more position level? I mean, you guys already have managed accounts, so you have position level reporting, but was it more frequent discussions? How did it change during the heat of the crisis?
Well, we have managed accounts, and we have real-time tick data for positions and performance across sectors and managers. It was quite interesting, everything. And of course, there were more meetings regarding risk management and manager performance. But regarding trade execution or on the operational side, there were no issues whatsoever. Most of the managers we invest trade futures, options, and FX forwards. But as we are quite active allocator, we try to add value on top of our managers. And this was the GCC. It was actually the most active time I remember since I joined RPM 15 years ago. So we did actually allocate actively between managers and subsidiaries. I closed one manager that had a risk breach. We increased allocations to other managers that were diversifying, etc. and so forth. So it was a quite active time regarding allocation overlay, but not risk management wise.
And Peter, how was the actual sort of peak of the crisis in March and April?
Yeah, just very busy. So yeah, it was just by nature of daily P&L and seeing things move around. It was a lot more phone calls and discussions with managers, and on both sides of managers having drawdowns and us deciding what to do in that scenario. Is it something where we should be reducing risk? Is it something where the worst time to reduce risk? And on the flip side, some great opportunities that, looking back, we took advantage of some, but when feels like you're staring into the abyss, and someone says, investment grade, short-term investment grade bonds have never gone down this fast. How much should we add? And, you do the best of what you think is prudent in the moment, but looking back, there were clearly some, maybe not once in a lifetime, but maybe once in a decade things that if you weren't quick to take advantage of, the snapback was just insanely fast. So yeah, those discussions, it was every day. There were multiple across 100 managers, as you'd imagine. Every day there were a lot of decisions that needed to be made.
So Gustav, from the other side of the table, I'm sure you have quite a number of investors. How would you say your workload from a due diligence and allocator communication perspective increased?
Yeah, I would say early on in the crisis, there was a significant drop off in sort of new allocators doing diligence, I think, because then there was, the lack of being able to do on-site and things like that. I think people just sort of pushed the pause button a little bit on that with respect to new allocations. With existing investors, there was very active dialogue and a lot of continued interest and sort of kind of further diligence and whatnot. So when from an allocation perspective, we saw a lot of inflows coming in from our existing folks because they were comfortable to pull the trigger very quickly. But it's really only been in the last 2-3 months where we've seen a real uptick in terms of new allocators really going down the diligence path. I think more a function of adjusting to the environment and realizing they can't sit on the sidelines forever. And so it's still a multi-month process, of course, but I think at this point there is much more of an appreciation that the diligence process can work remotely. Just you do more Zoom calls, you do a lot more online demos and whatnot, and you actually, I think probably speak with more folks within the firm, because people are just a lot more accessible since everybody's working from home. So, you have a chance to meet with department heads to run specific areas to get comfortable on the ODD side as well. And so we've seen an evolution over the crisis, but at this point it's normalized quite a bit with the obvious lack of on-site visits still being the case.
As we come to the end here, I just have one last question for each of you. Having survived, the crisis of the decade so far, what's the one takeaway for the next crisis, and how will you handle it differently, Peter?
Oh man. Okay. One takeaway. I don't know. I think the value of fast and good communication. I mean, not that it was something we needed to do better, but it was so valuable, having everyone very accessible. So I think having ways, at least for us, right, if we have that many people that are 100, let's say, managers and our team, probably making the opportunity for people raising their hand on what they see as the trade of the decade even more explicit, right? I mean, I can't think of anyone where we missed anything, but I think just encouraging managers who are in the midst of their market to be even more proactive. I would say that's unfortunately you just don't know if you're in the where you are in that trough when it happens, and knowing obviously on our side when to size things up. But I think encouraging people to be really raising their hand for adding risk at those times.
Alex?
From an operations allocators perspective, I would say once again proven the value of investing through separately managed accounts, having daily liquidity and intraday transparency. That helped a lot and gives a lot of makes us sleep well at night. From a strategy perspective, I would say simple, more robust strategies beat more sophisticated, complex systems again in a crisis. But then again, you have the trade-off over the long run. Obviously, the more sophisticated strategies have better returns. So it's a decision you have to make.
And finally, Gustav, what would you do differently?
I think it's, we had the good fortune to navigate this crisis pretty well, but I think it taught us a few things. I think it really taught us the value that you can get from a strong collaborative culture. I know Peter mentioned that as well. The value of proactive risk management and deeply integrated risk management with the investment function. And lastly, I think the value of being nimble, liquidity for lack of a better word, where sort of in the depths of the crisis in mid-March, you saw frankly, fixed income markets freeze up, and you saw these vast unwinds where the illiquid positions and strategies were kind of left to ride it out, and it ended up being a V-shaped recovery. So a lot of people ended up being forgiven for that mistake, but I think no crisis is like the last. So I think that certainly kind of emphasized how important that is. The very last thing I'd close with is actually less about sort of learning lessons, but more about the kind of the benefits of a crisis like this, really from a diligence perspective, or from a manager evaluation perspective. Even when you were looking at evaluating managers internally, the value of seeing how folks not just perform, but also respond and act, kind of how the process evolves during a crisis like this is invaluable in terms of having a conviction to really, scale behind a portfolio manager or to hire somebody from the outside where you're looking to bring on board a sort of a differentiated, diversifying a manager to platform.
Well, hopefully the next time we have this conversation, we can all be in person.
Definitely.
Cheers to that.
That'd be good.
And so I just want to thank this panel. You guys did a great job. And this is totally optional, but I know one of you has some great lower body fashion going on. Are you going to show it off or not? No obligation.
If you do, obligation. Well, no, what do you mean there's no obligation? You can't call someone out like that. But I'm not trying to
by name. I didn't call you out by name.
No, but that was about as strong arm twisting as you could do. So I'm not doing a turnaround for you, but that's how much I love you, James. So hope that made your day.
It really did. I'm always on board with the Nantucket Reds. So if anybody else is wearing a Speedo or anything, feel free, as long as it's covered. As long as it's covered. No. Okay. Thank you, gentlemen.
Thank you.
Pleasure to have you as always.
Thank you.